Welcome everybody from whatever country it is around the world you're listening from. Happy holidays, end of December 2022. And if you've ever been wondering what we mean by the term pair trading, then this is the presentation for you. First off, thank you for joining us. My name is Geoff Hossie, and today we are going to reveal to you a well-kept hedge fund secret that can allow you to build a successful and, most importantly, consistently profitable trading business. Okay, so pretty easy to guess. That secret is stock pair trading. What do we mean by stock pair trading? Well, very simply, simultaneously you enter long and short two paired shares. So let's take an example of IBM and Microsoft. At some points in their history could be considered fundamentally correlated, similar businesses with co-integration and correlation. If you were to put a pair trade on, it would be because the relative performance between the two you think is out of whack. So you might go long $100,000 of IBM while at the same time going short $100,000 of Microsoft. There's a long leg and a short leg, and they're in equal dollar amounts. And that type of trading technique, called pair trading, is widely used by professionals around the world due to its proven success over many years. And in this presentation, we'll take you through some of the research that backs that up. So why has this strategy been so widely adopted by market professionals, stock traders? They love its controlled risk and its low correlation to the market averages. So whether it's a bear market, a bull market, or a sideways market, the pair trading opportunity set always exists. And most importantly, it's the ability to generate significant and consistent returns across all of those different market environments. Let's take a second now just to look at the history of where it came from. The strategy was originally credited to this gentleman here. His name is Alfred Winslow Jones, and he's an Australian immigrant to the United States. He was educated at Harvard and Columbia, and he founded an investment fund, which was called A.W. Jones & Co. And because of its success, he was profiled by Carol Loomis in Fortune magazine, and she coined the term hedge fund, which is where that term comes from. So what did Jones do? Let's take a simplistic view of it and see what his innovation was all about. So Jones married two speculative tools, either one of which could have been considered quite risky, to create what he considered to be a conservative investment scheme. The first was leverage, and he would use it to buy more shares than his equity balance. And the second was short selling. And so he coupled the leverage of long leverage with short selling to avoid market risk. So how did he do that? He would buy as many stocks as he sold, and the market-wide moves up or down would be a wash, because if he's 10 million long and 10 million short, given equal betas between both the long and short positions, there would be no relative movement given an up move or down move or sideways move in the market. The crucial question then to make money would not be the direction of the market, but whether or not the manager has picked the right stocks to buy and sell. How did Jones do? Well, Carol Loomis's article was titled "The Jones That Nobody Keeps Up With," and you can see that here in this graph that we've been able to pull up from way back in the 60s. For the 5 years 1960 to 65, Jones's fund returned more than 325%, and that's despite a 20% management and incentive fee on an annual basis. On a 10-year basis, Mr. Jones' fund delivered 670% net return to investors, almost 7 times their money after that 20% management incentive fee. So the answer is he did very well indeed. So what about a more recent history of pair trading? Well, modern pair trading is generally credited to Morgan Stanley back in the early 1980s. And there was a group there of computer scientists and a quant trader, Jerry Bamberger, David Shaw, and Nunzio Tartaglia. And they got together and worked as part of an ultra-secretive group that was in search of the holy grail of trading. And where did they focus on in order to try and find that? Well, the group studied arbitrage opportunities in equities. And they employed advanced statistical modeling and developed an automated trading program to exploit market imbalances. And in 1987, which was the only year that they broke out the results of this special trading group, it was known that the group made more than 50 million profit for Morgan Stanley. That's about 131 million in today's terms. So they were doing very well indeed. More recently, it's worth taking note that the largest hedge fund in the world uses pair trading. Jim Simons, who you can see over here sitting giving testimony to Congress, he is the CEO of Renaissance Technologies, and he testified to Congress in November 2008 after the financial market meltdown that his fund focuses on pair trading stocks. You can see this on a YouTube address here that's on our YouTube channel. Their flagship fund at Renaissance is called the Medallion Fund, and as he says, it's mostly run for fund employees, and I believe it's capped at $1 billion. The Medallion Fund is famed for the best investment record in history, and they've returned more than 66% annualized before fees over a 30-year span from 1988 to 2018, and that's 30 years. And the rate of return that we've highlighted here, 66% before fees, would have turned $1 invested at the beginning of that period into over $4 million 30 years later. So do we have your attention yet about pair trading? Okay, that's all well and good for the institutions with their floors and floors of PhDs and hundreds of millions of dollars of trading infrastructure budget to find the best possible opportunities. What about the online trader? Well, let's highlight something that Chris Stone said of Investopedia in an article titled "The Secret of Finding Profit in Pairs Trading." It is rarely in the best interest of investment bankers and mutual fund managers to share profitable trading strategies with the public. So the pairs trade remained a secret of the pros and a few deft individuals until the advent of the internet. So recent studies covered below in this presentation show that this trading style continues to deliver superior returns with lower risk, especially in volatile markets. However, now it's not just the institutions. The internet, advancements in computer power, trading software platforms, for example like ours, PairTradeFinder Pro, cheap real-time market data, or even free, low or zero online brokerage commissions, and leverage available for the retail trader through CFDs or portfolio margin have really leveled the playing field with the institutions. That said, to be better or have a chance of competing with these institutions, retail traders have to use the one real advantage that they have, and that is their small size. You can use it to profit in areas where a larger fund of hundreds of millions of dollars would not be able to profitably undertake an arbitrage. So before we take you through the anatomy of exactly how to do a pair trade, why does it work? Well, contrary to popular belief, a form of logic does run through the world's stock markets. Most of the time, stocks are priced efficiently. That is, all information is discounted in a logical relative manner and is reflected in the price. However, every now and then, the market does something unexpected and it creates an inefficiency or an anomaly. For example, a school of fish all swimming one way. Well, one of them all of a sudden decides to go another way. What are the chances he rejoins the school? Pretty good. So look for those outliers. And why do they happen? Well, they can happen for many reasons. A large block trade in Coke, which wasn't replicated by somebody else buying Pepsi at the same time to take advantage of the price differential between highly correlated companies. So stocks don't buy and sell themselves. These orders are entered by people, and people are driven by emotions, and emotions cause irrational decisions, especially around earnings times, especially around any major announcement that could have major fundamental effects on any given share. This emotional decision-making characteristic is multiplied exponentially when it comes to crowds of people and momentum following high-speed trading algorithms. So here enters the arbitrageur. Stock pairs trading is a form of statistical arbitrage. We trade pairs of fundamentally correlated liquid equities that have demonstrated strong historical statistical co-integration and correlation in the price relationship. And if these terms sound difficult to grasp, don't worry about that. We've set up PairTradeFinder Pro so that it's very, very easy to identify good pairs to trade and when to get into them and when to get out of them. So when one stock in the pair significantly outperforms the other for no good publicly available reason that would justify a change in its valuation, we cut it down by selling it short while taking an equally sized long position in its mate or highly correlated and co-integrated mate stock. When their relative price performance converges, we profit. So again, if for no good or explainable reason, i.e. you must check the news, such as news affecting fundamentals, two highly correlated shares for example, let's look at Chipotle Mexican Grill and Starbucks, diverge away from each other, then there's an inefficiency created and an opportunity to profit. How we enter a pair trade. We buy long the relatively weaker share of the pair, the long leg, and we sell short the relatively stronger share of the pair, the short leg, in equal dollar amounts to stay market neutral. And as these are highly correlated and co-integrated companies, they should likely have a very similar beta. So you're also very close to beta neutral if you're dollar neutral in very closely related companies. Sometimes a picture is worth $1,000. So let's just go through this graph quickly. So this is a graph right now of the relative price performance of CMG, Chipotle, Mexican Grill versus Starbucks, two highly fundamentally correlated and co-integrated companies over the last year at least. So this is the last year. Both fell in price. Their performance was poor. And then their performance started to diverge. Well, what do we do when we pair trade? We say these two shares should be performing more or less equally. So when there's a big divergence in the relative performance, for example here, we would sell short Chipotle, buy long Starbucks, and then wait for this relative performance to reconverge. Close the trade here. And if you look at this graph, if you bought long $10,000 here, you would have lost money, and then right here, maybe broken even or made a slight bit of money. However, at the same time you sold short $10,000 of Chipotle, you made a large gain on that, about 20%. Yeah, 20%. So $2,000 and zero on this, you would have made $2,000 on a 10,000 leg trade. And that's what pair trading is all about. So when do we know when to get in? Well, we do this once the price ratio, so the share price of CMG divided by the share price of SBUX, which we can see here, here's the ratio. You know, it goes somewhere between 15 up to 19, waves around. And this is the moving average of that ratio over the last 50 days. And then the light green line is the actual daily readings of that ratio at the close. So what do? We wait for this daily ratio to diverge from the moving average sufficiently based in standard deviations for us to consider that statistically it's gone a long way, probably won't go further, and is likely to reconverge. And so we do that on a plus minus chart in Pair Trade Finder Pro. This is measuring the standard deviations, either positive or negative, of the light green line versus the moving average, the darker blue line. And as you can see, whenever I think our entry stretch here was 2.7. Whenever it hit 2.7, we entered, and our exit stretch was set at 1 standard deviation. So whenever it came back to 1, we exited. Now, how did that work out? Well, this trade, you bought here, exited here, made money. Bought here, exited here, made money. Bought here, exited here, made money. Could have made a lot more if you'd held all the way to 0 standard deviations. Here, we bought here, exited here, also made money. So the exit occurs when the two securities' relative performance has reconverged to our desired exit level. Could be 0, could be 1, up to you what you want to set. It may sound a bit too good to be true, but let's have a think about this for a second. Why does pair trading work? Well, it works because the relationship between two correlated stocks is much more predictable and reliable than the outright prediction of the direction of a particular stock. So saying I want to go long the index now, or I want to go short the index now, it's hard to know where you're going to be in 6 months' time. Here we've graphed the relative performance of SPY ETF versus the DIA ETF. And the point I'm trying to make is the following. So when you buy SPY here, you don't really know where you're going to be in 3 or 4 months' time. Are you going to be higher? Or are you going to be lower? You just don't know. But if you buy DYA at the same time, it's likely that they're going to be going in the same direction in a similar amount of relative performance. So what that means is, when you look at the red and green lines, if they diverge very substantially, for example here, you could short SPY and go long DIA here and wait for the relative performance to reconverge, for example here. And you would have lost money on your SPY short, but you would have made more money on your DIA long. And as a result, you have a profit. And it didn't matter whether the market went up, sideways, or down. What mattered is that these two lines reconverge. And it's much easier to predict that two highly correlated stocks are eventually going to revert to a similar type of performance than knowing whether that performance is going to be positive, negative, or stationary. So equities pair trading is easy to learn, and it can generate significant recurring income with measured risk. It can be done from anywhere in the world with a broadband connection and requires only a limited time commitment. So recent research demonstrates a significant profitability. So we mentioned this earlier in the presentation. It's been backed up by significant academic research of all types, showing that this profitable trading strategy persists, and not fully understood why, but it continues to persist. In this study in 2012, they found significant abnormal returns, alphas of up to 36% annually for an equally weighted, unlevered portfolio of long-short pairs trading. And if you put leverage on that, obviously you can increase those returns. Another excellent study back in 2015 on what type of pairs trading method one might use. It looked at 3 different types, and it looked specifically at co-integration, which it found was the best. And it says returns are especially high with co-integration based pairs trading, with monthly excess returns, we're talking monthly here, after transaction costs, greater than 1.4% and going up to almost 5% over a period of more than 10 years. Okay, these are clearly the main and most impressive empirical findings of this article. So demonstrated profitability from a research point of view. You have most of the professional hedge funds managers using this type of strategy at some point. And that should be enough to tell you that there's definitely something here that's worth your time to take a look at if you're looking to build a successful trading business. So pair trading with Pair Trade Finder Pro, our platform, which is designed to make this simple and easy for you to do, takes perhaps about 30 to 60 minutes per day once you've learned your craft. And how does it work? What's a typical month look like? Well, typical pair trades generally last about 8 to 20 days each based on the settings we like to use. And the average is maybe around 12 days. So a dedicated pair trader will typically have at least 15 to 25 pairs on at any given time. That's between 30 and 50 single stock names. And generally about 30 pair trades per month based on the average trade duration. That means that you're probably entering and exiting 1 to 2 trades per day. And trades are entered in the last hour before US or other market close, or about 30 minutes after the market open. And that's the way you can make sure that this strategy doesn't take too much of your time. You trade it on a quasi end of day basis. However, if you want to do the full intraday session, it does maximize the opportunity set, as intraday price swings can call trades that aren't called by end of day pricing. So all in all, the minimum time commitment works out to about 20 hours per month. So those numbers may have impressed some of you or may not have impressed some of you, but let's just think for a second. What could a 2 to 3% per month, which is about 35% per annum, in consistent trading earnings mean in income terms? And remember, you're doing this in maybe 20, 30, 40 minutes a day, Monday to Friday. Well, on a $100,000 indicative account, this is what 35% compounded over 15 years looks like. And while you start at the beginning of year 0 at only 100,000, by year 10, the account's grown to over 2 million, a 20 times multiple. By year 15, that account's grown to 9 million, a 90 times multiple. That's at 35% compounded over 15 years. And that's why you can see these types of returns we were talking about with the Renaissance Technologies, Medallion Fund, D.E. Shaw, and some of the others. So this is a very short introduction to the world of pair trading and the anatomy of how to make a pair trade and what pair trading might be able to do for you. Happy trading, everyone.